Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. ChargePoint was one of the hottest stocks on the market when the pandemic began. The company really rose to prominence in late 2020, early 2021, reached nearly $50 per share, and the stock has dropped almost 90% since then. But this still isn't a stock that I would buy right now, and I want to get into exactly why with 3 predictions for the company that could actually indicate a fair amount of growth in the future, but not necessarily improvement in the bottom line or the stock price. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And first, I want to show a little bit of background on ChargePoint's financials because I think that's a great place to start. This is ChargePoint's stock price history, and then there's a bunch of information over here on the right-hand side. Price to earnings multiple, which doesn't exist because ChargePoint is not profitable, but we do have an enterprise value to sales multiple on a trailing 12-month basis that is 3.8. So still a relatively expensive stock. You can find lots of stocks out there that are growing revenue steadily that are trading at under a 3.8 multiple. So we can also see here that there is debt on the balance sheet, $319 million, offset by a fair amount of cash, but this is not a debt-free company. Now, if we look at financials, this is where things really start to fall apart for ChargePoint. You can see that revenue grew tremendously starting in 2020, but that has really trailed off the last couple of quarters. If we pull in net income, you can see that the company is not only losing money, but it's losing more and more money each quarter. So just terrible financial trends for ChargePoint. But the company is still a going concern because it does have plenty of cash on the balance sheet to fund operations for the time being. So that gets me to the predictions that I want to make for today, because the charging business should be a very big business long term. This is not the kind of business that is going to go away anytime soon. The value of chargers just continues to increase as more and more electric vehicles get on the market. But that doesn't mean that all of these companies are going to make money. And one of the reasons is ChargePoint and other charging companies are going to have to adopt Tesla's charging standard. Now, this isn't going to cost them money, but it's going to reinforce the fact that the plug itself is a commodity. The plug that you're going to put in your car from a ChargePoint charger, from a supercharger, from a Blink charger are going to be exactly the same plug. So what difference does it make whether you use ChargePoint or another different charging service? That goes for both the chargers themselves. Remember that a vast majority of ChargePoint's revenue is actually just from selling chargers, not actually selling electricity. So that charger itself becomes more of a commodity, and the electricity, it's already a commodity, and it's going to be further commoditized, being that most of North America is on a standard plug. I think we're going to see a similar standard. Maybe it won't be the Tesla standard, but chargers standardize around the world. It seems like here in North America, they are standardizing around the Tesla North American charging standard. So that's really the first prediction, is that ChargePoint is going to lean into that charging standard, but it's not actually going to help them from a strategic standpoint. And that gets me to the second point, which is that ChargePoint is going to continue losing money. I showed the chart earlier of how much money they're losing right now. In the trailing 12 months, they have lost $368 million. That is just a tremendous loss for a company that has about a $2 billion market cap and is just not sustainable. There's also no reason to think that those losses are going to turn around anytime soon. If your product is being commoditized and now you're competing with the biggest charging networks that is out there, that's Tesla's charging network, that's going to put you in a really tough strategic position. And that leads me to the third thing, and that is that ChargePoint is going to have to raise more money to continue its operations. Unless the stock just completely collapses, I think the company is going to have to issue more shares to fund operations in the relatively near future, because you don't want to get to the point where the market can see that you're running out of cash. So ChargePoint is going to have to use that falling stock price to actually raise more cash. And I think that's something they'll likely do in the future. Debt is probably going to be very expensive to raise, whether that's convertible debt or traditional debt with an interest payment. So I think the company is going to turn to stockholders and issue more stock to continue operations and try to turn around the financials. Like I mentioned earlier, I think turning around this business is going to be much, much harder than a lot of investors predict. But what do you think? I'd love to hear your comments. I'd love to hear your thoughts about ChargePoint in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.